All right, Joe, what about you?
I'm keeping my eye on the Dallas-Fort Worth market. The area is growing, the economy is booming, and there's an interesting trend. The economists I follow, they talk about a divide in the country over the last 10 or 12 years between urban versus rural. And 85% of the jobs created since the global financial crisis have been in urban areas at the expense of rural, because rural doesn't have broadband. But now in places like New York, we're seeing the downside of urban, where there's congested populations and no way to get social distancing. So some economists are thinking that the pendulum is going to swing the other way, and there's going to be a move more towards further away from the major metros. And we've already seen that in Dallas. Our team there doesn't invest in Dallas proper because it's so expensive. It doesn't cash flow anymore. So they've been going out further out, like 20 miles east of Dallas, 30 miles south of Dallas, north of Dallas, further out. So if the pendulum does swing, we're already seeing for financial reasons to move out to the further out areas, but now there's a health reason to also move further out. So I'm watching that very closely because that looks like an interesting trend. Some of the virus effects are making people do things that they didn't do before, or companies do things they didn't do before. But other effects of the virus are to accelerate a trend that's already in place. And we've been seeing that trend in Dallas for a while now, and so the virus may accelerate that one. So I'm keeping an eye on that.
I mean, if you figure how many companies are thinking, wow, I can save so much money now that I know that people can work from home. And if people can work from home, they're maybe going to want a nicer home with more space and maybe a room for an office. And yeah, it does seem to be accelerating what was already there. Aristotle, what about you? And by the way, I do want to say this is not wine. It's elderberry juice, you know.
This is not
Someone
vodka.
said maybe it should be. I don't know. All right, Aristotle.
Yeah, I thought that was wine that you're taking a sip of. I was like, oh,
I know,
loosen up
it
a
looks
little
like
bit.
it.
So no, I'm gonna start real quick with what Joe was saying. I actually watched something in the news about a week ago about this couple that lived in New York, and they wanted to get out of all the chaos and how crowded it is, and they actually ended up buying a house in New Jersey, which is not too far away. And they're in a suburban neighborhood, and they were talking exactly what Joe was talking about, how people probably are, if they can, they want to move away, at least probably for the next year, I don't know, next 12 months, people want to move away, and that's going to be a trend that you're going to see in the big cities. But places like Dallas, it's very sprawled out, right? So they have a downtown area, of course, but you're going to see some of that, but you'll see it in more like New York, which we're not invested in anyway. But the markets that I mean, the markets that I'm would be more bullish on would be places like where the medical and the military is. So places like Cleveland, right? Kathy, you said many times that you had a property out there where a nurse leased your duplex or your property for like on a 5-year lease, right? So think about all the people that are doing residencies and people who are, I mean, that medical field is never going to go away, and you're always going to have more and more people. So if you're close to a medical facility like the Cleveland Clinic, and there's other facilities there too, I think you have a much higher chance of keeping a tenant or having a tenant there. And then military, of course, we're not necessarily on any military bases, but places like Huntsville, Montgomery, and Birmingham, those all have military bases there where there could possibly be people renting your houses that work on the base. Maybe they're not active in the military, but they could be cooks, they could be technicians, they could be all kinds of stuff, and nurses, doctors, and they work on the base there. I think like Redstone Arsenal, which is in Huntsville, right? I think they employ like over 10,000 people, I think, in there, or close to it, I think. 20,000, yeah. So it's a lot. So the M&M, I always say the M&M, the medical and military, I think those are great options. So wherever those industries are, I think that's a safe bet. Then another thing also that I've been talking about to members is Section 8. So if you don't know what Section 8 is, I won't spend necessarily a ton of time talking about it. We don't have time. But if you can get the government to pay for 70 or 80% of your rents, I think that's a great way to go for the next 12 months, right? Because that's, you know, even if your tenant loses their job, they're working retail or whatever, you're still going to get most of your rent. So, and we do have some places that do specialize in Section 8, but there are other management companies that don't. So you can talk with one of us about which markets do, which markets don't. But I think Section 8 is I don't want to say fail-safe, but it's a pretty good sector to think about if you want to invest today. I think it's a great sector to get into.
Yeah.
Great. Leah.
I think it's worth tagging on too about Jacksonville. Jacksonville's very heavily military as well. I think the Naval Air Base there employs like 30,000 people, military and civilian. So a good stable market for government employment as well.
And Tampa.
Yeah.
Yep.
Yep. Me personally, I feel like I kind of probably hyper focused when I was building my personal portfolio on high cash flow markets, what we call linear markets. Linear is in reference to property value. They're flat, they're stable, but they have higher rent to value ratios and maximum cash flow. And I chose to kind of focus on those initially, just to get into as many properties as quick as I could so that I could create this kind of self-sustaining portfolio that generated enough cash flow that now it can cover maintenance and vacancy, and it's something that's kind of going on its own. And so we had made the shift to kind of start focusing on more growth focused markets just to kind of give it some balance. We're younger, so we have plenty of time to recover. Not that we're investing in risky things, but knowing that, hey, we need to be investing in these markets that have this upward potential too. So our focus prior to COVID had kind of shifted to these growth markets. And so we went under contract on a quad in Jacksonville, which has also been a long time coming, but is finally closing this next month. We just closed on a second property in Houston at the end of January. So my mind has all kind of been focused on these growth markets where there's little more appreciation potential, but still good cash flow. Do I think that strategy has been just totally rocked in this situation? No, because again, I think you're still focusing on fundamentals, still being really careful in your due diligence. I'm not getting obsessed over the looking for a good deal. Am I overbuying? Am I buying at the top of the market? Because again, we're buying at these very affordable price points. So when I talk to clients, I have a hard time kind of pointing them one direction or the other simply based on this crisis. I feel like you really have to consider more like where you're at. What are your goals? I mean, do you need the cash flow today? Or are you wanting the cash flow 10 years from now? So I don't think that's changed. I think a lot of it still kind of really depends on what it is that you're looking to do. Personally, still focused on growth, and I will be for my next acquisition as well.
Great. Okay, let's get to the questions. I won't read the whole question, but I'll give the gist of it. Robert says, I've been talking to the different teams and I'm confused because some will say it's a C property, or a B property, but the property manager says it's a C, or vice versa. Like what he said, can you just have everybody speak the same language? So Ben.
Yeah, I feel the same.
We tried.
Yeah, I know. And Robert's absolutely right. The problem with those ABC grades is they're completely subjective. I mean, a C in Pittsburgh is completely different from a C in Houston. I mean, it's just completely different. The properties, the neighborhoods were built 50 years in a different time period, and it's a different mentality. And then people's subjectivity and what they think is an ABC. So I always issue that huge disclaimer. But I think Tim Horvath, our director of property teams, has a potential solution that I hope I'm not overstepping here, but there's a website called niche.com, NICHE.com. I believe that's it. And you enter in a zip code and it gives you the neighborhood grade, among other things.
Oh,
so
wow.
I think what we're going to start doing, and he's spot tested it, I've spot tested it. It seems to be more or less accurate, and at least they presumably are using the same methodology for every zip code. So I think we're going to start relying on that a little bit more rather than just word of mouth from the team in that local market who's subject to their opinions. So I think that, Robert, will really help you, but you can check it out, niche.com.
Yeah, the other thing I would add to that is just qualitatively, you should understand the difference. The B neighborhood is basically an owner-occupant neighborhood where everybody has the pride of ownership in their home. They own their property, and you might own the one rental on that street. A C neighborhood tends to be more of a rental neighborhood, a lot of fourplexes, apartments, and tenants don't take care of a house the same way an owner would. So the neighborhood can deteriorate in the C neighborhood a lot faster. And then secondly, when you go to sell the property, a B neighborhood, you have more exit strategy. You can sell to an owner occupant or you can sell to another investor. Whereas in the C neighborhood, you only have one option, that's to sell to an investor. And they're looking at it solely as an investment in dollars and cents terms. There's no emotion to it. So it's generally safer to be in the B neighborhoods, but think in terms of, is this a tenant neighborhood or is this a owner occupant neighborhood? And that website, niche.com, will tell you what % in that zip code rent versus own. And I personally prefer a 2-to-1 ratio. I like to see twice as many owners. So 65% owners, 35% tenants. That works out.
And yet some C neighborhoods cash flow really well and
Yep.
do well. So it is just depends on the area.
C
Okay, here's a
neighborhood in
great
San
question.
Francisco is
Someone
$1 million.
said, yeah.
Yeah.
Someone said my rent is or my lease is up in June. Would you raise the rent?
I think it depends. I mean, it depends on the market. I mean, we talked with Leah Slaughter in Dallas yesterday, and she's saying that she's been able to push rents right now, that there's such demand. I mean, she got 90 applications last week for rental property. So it wouldn't make sense to reduce the rent there, I don't think. Obviously, there's individual situations, but in other markets, I think maybe you need to back off a little bit. But I'm not hearing from any of our teams that there's drastic rent reductions happening right now. If anything, it's maybe, $25, $50.
Okay, great.
Yeah,
Here's
well,
another. Oh, go ahead.
I was going to add real quickly. Yeah, the one thing to think about is that if you don't have much money right now to move, you're not going to move right from your house. So even if you raise your rent by $25, it's not worth for you to get a moving truck and get all this money for deposits and everything just to move to save $25.
So yeah, I would talk to the property manager. They usually have a good sense of it.
Mm-hmm.
Okay, let's see. Oh, taxes. All right, this is a great question. With every state, you're invested in all these different states and they all have different taxes, and he says it's getting expensive to put that return together. So any thoughts on what you do at tax time?
Yeah, Michael's basically, he's just saying, the more states I own property in, the more complicated and scary the whole tax situation becomes, and how do we handle it? And of course, we're not tax advisors. I always say that really loud and clear. My personal opinion is, if I bought a house in Alabama tomorrow, obviously if I bought in Florida or Texas, there's no state income tax. So it's kind of a no-brainer. It just goes on your Schedule E and flows through. But if I bought a house in Alabama tomorrow, yeah, I might have to fill out a Alabama state tax return. But my experience has been it hasn't been that big of a deal. If one's using a CPA, they've already entered all your data. They just click the Alabama button and spit out the Alabama non-resident income tax return, and maybe they'll charge you $100. I mean, I don't know. It's not that big of a thing, but I think it goes to, there's no reason to own 14 properties in 11 states. It makes more sense to own 14 properties in 2 or maybe 3 for that reason.
Yeah,
that's my
agreed.
opinion.
I just have my CPA just file the return for me. So, but I don't. So actually, it's an interesting question, because I had somebody ask me that before, not too long ago. They said, well, I'm maybe thinking about buying in this market or that market, but I don't know, because I don't want to do all the tax returns. I'm like, it's not that big of a deal. Like Ben said, it's like, it's, $50, $100 extra your CPA charges you to do it, and they just file it in the state, and that's electronically. It's very easy to do.
Okay, $1 trillion question. How do you think the $1 trillion of stimulus will affect real estate and the economy? Joe, you look like you're ready.
Well, the first thing you would think of is inflation, because the government's printing trillions of dollars out of thin air, and that could cause inflation. And inflation is generally good for real estate investors, because you can pay off your mortgage in inflated dollars, and also your rents and property values go up, at least in nominal terms. Now, the caveat is that everyone thought the same thing in 2008, and the inflation never materialized. That's because the money went to the banks, and from there went into stock markets. So the only thing that got inflated were financial assets. This time around, money's going to small business owners and workers who are laid off, and into the real economy, in other words. And also this time, the government's not printing billions, they're printing trillions at a time. So we dodged the inflation bullet last time, but it's not clear that we're going to dodge it this time. It's entirely possible we're going to have inflation, which over the next 10 years is bullish for real estate.
Yeah.
And that will affect interest rates quite a bit.
Yeah.
Mortgage rates.
Same person asked, okay, on the flip side, there's all these job losses, 30 million or whatever we're at this point, who knows? Do you see Q3 and Q4 just being a complete foreclosure crisis?
I don't think that soon, no. I mean, I think that it's evident that the government is stepping in to try to, mitigate that and prevent people from being kicked out of their homes and losing their homes. So I think, Q3 might be a little soon to see any of that. Yeah, I think if we see any pullback, it'll be a little bit later as far as real estate opportunity. I predict that it probably wouldn't happen until January, February timeframe.
Unless you're in commercial, there might be some things coming down. And it might not happen at all. It just all depends. A lot of, like, Goldman Sachs is expecting Q3 to be outrageously fantastic. So they must think that there's going to be some kind of, I don't know. We'll see. Hopefully a cure.
So Goldman's in the V recovery stance,
Oh,
right?
Goldman, when I did the presentation last week, I showed some slides and they were very bullish for 3 and 4, which would be basically starting, summer. So somehow these big money guys are thinking that that people will be having their jobs back by summer. Who knows, right? Only time will tell. Yeah.
I heard this great analogy that was given about kind of in reference to the stimulus and its impact. And the analogy was that, we're in this car and we're being given all the stimulus, we're flooring the gas, but the car is in neutral, or the car is in park. Like the stimulus can't, you can floor the gas all you want, but until you have the car in drive, like there's nothing that it can do. And so, we're just now putting the car back in drive, and, we're going to see how it plays out. And I think there's a high likelihood that it could play out pretty different in different parts of the country. Just, with the fact that stimulus goes much further in some locations than others. So, I mean, time will tell, but.
Well, that's exactly it. If you're getting a $1,200 stimulus check and you're a couple, that's $2,400, and your rent is what, $950, $1,000, $1,200. It's a lot different than if you're in California and the rent's a lot higher.